This is an Oppo phone. But if you turn it around, you see that it's being manufactured by Bhagwati Electronics. So you must be thinking, what even is Bhagwati Electronics? And I agree with you, because before today, even I didn't know what it was. Turns out it's the parent company of Micromax, and it's going for an IPO worth $2.5 billion. Yup, you heard it right. $2.5 billion. You remember Micromax, right? Every middle class Indian family owned it at some point of time. Canvas, Ninja, Bolt. Phones with aspirational names made for a country that couldn't yet afford iPhones. And then around 2016, they vanished. Why, you ask? Xiaomi, Oppo, Vivo, the Chinese brands happened. And the Indian smartphone brand that once had 18% market share became a footnote. But wait, the pre-IPO chatter in front of me says Micromax is back. Goldman Sachs and Kotak on the deal. A potential 2027 listing. Wow. You know what? This is going to be sold as a comeback story. Proof that Make in India worked. Proof that the PLI scheme delivered. Proof that India is finally becoming the manufacturing power that we always aspired to be. Well, I don't think it's any of those things. I think it's the clearest test case we have had of what India's manufacturing boom actually is. To understand the Bhagwati IPO, you need to hold 3 government decisions in your head. They were made by the same government for the same stated reason, and at least one of them contradicts the other. Decision 1, April 2020. A few weeks before 20 Indian soldiers were killed at Galwan, the government issued Press Note 3. Any foreign investment from a country that shares a land border with India now needed explicit government approval. On paper, there were 7 countries, in practice, only 1. So as per Indian FDI rules, money can come in 2 ways. Number 1, automatic, meaning no permission needed, just file the paperwork. Number 2, approval route, meaning that the government has to say yes first. Press Note 3 forced every Chinese investment into the second bucket. Between 2020 and 2024, Chinese FDI into India collapsed from 2% of total inflows to 0.25%. $8 billion of proposals were filed, only $1.4 billion got approved. If you were a Chinese venture in 2022, this was roughly the government equivalent of being put on red. Decision 2, also 2020. The government launches the Production-Linked Incentive Scheme for smartphones. Oh, by the way, what's PLI? It's simple actually. The government tells a manufacturer, hit these production targets and will give you cash back as a percentage of what you make. The more you make, the more you get. And the budget? 34,000 crore rupees. It's a lot of money. But the real goal wasn't assembly. The real goal was what MeitY, or Ministry of Electronics and Information Technology, called domestic value addition. You know what? Forget the term. Here's what it actually means. When a phone gets sold for, let's say, 10,000 rupees, how much of that 10,000 was actually made in India? The screen, the chip, the battery, the design. How much of the value of the phone was created here versus just being imported and assembled together? That's the number that matters, because if you're just importing every part from China and screwing them together in Noida, you're not really making phones. You're just a final assembly line. The actual industry, like parts, design, or components, still lives somewhere else. The PLI scheme set a specific target. When it launched, India was creating about 18% of each phone's value at home. By 2026, the goal was to push that to 35 or even 40%. But that didn't happen. According to industry estimates, which the Minister of State for Electronics confirmed publicly in March, actual value addition heading into 2026 is still 18 to 20%. Which means production went up, exports went up, jobs went up. But the actual metric the scheme was designed around, the one that defines whether India is making phones or just bolting them together, did not move. Assembly worked, everything under assembly did not. That leads us to Decision 3, February and March 2026. Cabinet approves a partial relaxation of Press Note 3. Chinese minority investment are now allowed via automatic route up to 10% in selected manufacturing sectors, including electronic components. The recommendation came from a Niti Aayog committee. This policy reversal was described in the press as easing. Giving up is also a kind of easing, right? Well, here's the situation the IPO walks into. The government created a rule in 2020 to keep Chinese money out. It spent 20,000 crore rupees trying to build an Indian manufacturing ecosystem without that money. The ecosystem didn't build. So in 2026, it quietly wrote an exception to the rule. And Bhagwati Products is the first big IPO that tests what that exception actually means. You know what? Let me steelman the government's version first, because the numbers really are impressive. Indian smartphone production went from 2 lakh crore rupees in 2021 to 5.5 lakh crore rupees in 2025. That's more than twice in 4 years. Mobile phone exports went from $200 million in 2017-2018 to $24 billion in 2024 and 25. Over 100-fold jump. I mean, over 100 times. And smartphones are now India's single largest export commodity. Apple alone has produced $70 billion worth of iPhones here over the PLI period and exported 51 billion of that. You know what? I'm just throwing numbers after numbers. I want you to understand the gravitas of it. We are literally talking about billions of dollars and billions of iPhones here. And I'm going to throw another number at you, which is even more impressive. The India Cellular and Electronics Association, which is also the industry body, did the math for me. For every 1 rupee the government spent on PLI subsidies, it got 19 rupees back. How, you ask? In taxes, GST when the phones get sold, import duties on the parts, and of course, corporate tax from the manufacturers. 1 rupee in, 19 rupees out. On paper, the scheme more than paid for itself. And the jobs are real. 12 lakh jobs, direct and indirect, according to government data. A lot of them women, a lot of them in small towns, and a lot of them are first-time formal sector employees. India now makes 99% of the phones Indians buy. India now exports phones to the US. India now is inside the global supply chain. And here is the part that really surprised me. India now is exporting components to China. PCBAs, housings, mechanical parts, $2.5 billion worth in the current financial year, projected to hit $3.5 billion by March. I know I'm just talking in billions, but the important thing here is that a few years ago, that number was almost zero. The direction of the trade is reversing. Indian factories are sophisticated enough to feed Chinese assembly lines for Apple. So if you're reading this as a story, the story is, it worked. India is climbing the ladder. China is losing the ground. The decoupling is happening. And that's the version you'll hear when the Bhagwati IPO goes to the market. It is the version that the bankers will write. It is the version that most business channels and Indian YouTube channels will repeat. But I want to show you why it may be wrong. Meet Huaqin Technologies. Yes, it's Huaqin and not Huaqin. At least that's what my translator told me. It's based in Shanghai, publicly listed on the Shanghai Stock Exchange. 2024 revenue, roughly 15 billion US dollars. According to Counterpoint Research, Huaqin was the world's largest original design manufacturer for mobiles, tablets, and even laptops in 2023, nearly 28% of the global market. By the way, an ODM is a company that designs and builds a phone for someone else, who then sticks their logo on the front and then sells it. The phone you bought from a famous brand, there is a real chance that the brand never actually built it. Most of the global mid-range Android market works this way. And in October 2024, Huaqin bought 49% of Bhagwati Products. The deal was lawyered by AZB and Partners, one of India's top corporate law firms. It required inter-ministerial approval because Press Note 3 was still in force. Remember Press Note 3? The border countries, the money, the scrutiny? Yes, that Press Note 3. Normally that process either takes years or quietly dies, but this one was cleared. But wait, there is something else you need to see. Bhagwati had missed its PLI targets in financial year 24 at the time that the reason they missed was that the company could not get enough orders from Chinese smartphone brands. Now Huaqin took 49%, The JV got approved. The orders Bhagwati could not get before from Vivo and Oppo started flowing. And that, my friends, is the 10 times revenue jump. Not a product breakthrough, not a factory upgrade, not a single new customer won through competitive sales, but basically a Chinese ODM took half the company and the orders arrived. And boy, did they arrive in huge numbers. Management's guidance for this financial year is 15,000 crore rupees, which is yet another 2.5 times jump. The company expects to cross 2 million devices, 8% of all smartphones manufactured in India. All of it riding on a Chinese order book, delivered through a Chinese minority stake in an Indian company that used to sell phones called Ninja. And Bhagwati isn't an outlier. Here is the industry it's joining. Enter Dixon Technologies, India's largest electronic manufacturing services company, the poster child of PLI story, with revenue in financial year 25 as 48,500 crores. Profit 1,800 crore. Net margin 3.7%. The first time I ran the math on that margin, I thought I had made an error somewhere. So it was time to look inside the 3.7%. There are two estimates of how much PLI contributes. Number one, JM Financial, the brokerage that covers Dixon. It says 60 basis points, which makes PLI roughly 15% of Dixon's profit. However, the industry estimate synthesized by Wales Book puts it at 1 to 1.5 percentage points, which will make it closer to 30%. So the point here is that if you just let go of all these percentage points, net margin mumbo jumbo, approximately 15 to 30% of Dixon's profit, depending on whose numbers you choose to use, is actually government subsidy. And the market already knows this, because Dixon's stock fell 40% in the 6 months before April 2026. The trigger was simple. PLI 1.0 expires in March 2026 and PLI 2.0 had not been confirmed. So, the most successful company in Indian electronics manufacturing space was priced as a government dependency story. I mean, let that sink in for a second. So 40,000 crore rupees in PLI incentives later, this is what the Indian EMS industry looks like. A poster child that cannot survive without subsidy. A press note 3 that had to be relaxed. And a Chinese majority orders company getting the biggest pre-IPO valuation in the sector. Is that decoupling? I don't think that's decoupling. I think that's restructuring, right? India gets the factory floor, the jobs, and the subsidy. China keeps the margin, the design, the IP, the customer relationships, and so on. And the pattern isn't just Bhagwati. Dixon's biggest growth bet is a pending JV with Vivo. Dixon also signed a JV with Longcheer, another Chinese ODM, in March 2026. The Chinese capability inside Indian shell pattern is industry-wide and not company-specific. The funny thing is, once you see the shape of that trade, you just cannot unsee it. The Bhagwati IPO is the first major listing that puts the trade on a public balance sheet. Here is what I think that the Bhagwati IPO actually tells us. And to be fair, it has very little to do with Bhagwati. For 6 years, the Indian government has been trying to resolve a contradiction it never publicly admitted, which is to block Chinese capital for security reasons. The way the government handled this contradiction for 6 years was to write strict rules and then make quite exceptions for the specific deals that were too important to kill. Wachin Bhagwati was one of those exceptions. What changed in 2026 was simple. The government admitted the exception regime was not working. Niti Aayog wrote it down. The Economic Survey published it. The cabinet ratified it, and here is the specific thing I want you to notice is a 49% stake, which is way above the new 10% automatic threshold. Under the new rules, Bhagwati would still require case-by-case approval. But here is what that new policy actually does. It creates a 60-day fast track for Chinese investments in 5 priority manufacturing sectors: capital goods, electronic capital goods, electronic components, polysilicon and ingot wafer. With one explicit condition: majority ownership and control must remain with Indian citizens. That's not a coincidence. That's a description of Bhagwati. Indian majority, Chinese minority. And Bhagwati isn't staying in assembly. The IPO proceeds are being raised partly to fund a move in 2 components. Display modules first, then mechanics. But notice what's not on that list. Not display panels, not chip design, not advanced sensors. just the next cheapest rung up from assembly. The new framework did not grandfather Bhagwati. It codified Bhagwati's structure as the official blueprint for the deals that come next. And it's being sold to the Indian retail investor with a Micromax logo on the cover. If Bhagwati prices at 20 to 25,000 crore rupees, if Goldman Sachs tell Indian mutual funds that this is the future of Indian manufacturing, then what gets funded is a dozen more Bhagwatis. JV structures having Chinese capabilities with Indian shell. That's not a pipeline, that's a template. And here is my actual claim. I don't think India is climbing the electronics ladder yet. India is occupying a specific rung on it, the assembly rung, and China is happy to let India have it. Because the higher rungs are where the margin lives. Value addition stuck at 20%, profits dependent on subsidy. Chinese ODMs are now openly welcomed back. Exports rising, but IP ownership is nowhere. If that's right, the Bhagwati IPO is not a problem. It is the system working as designed, just without the cover story. But here is what actually concerns me. The Bhagwati IPO will be priced as a comeback story. Micromax is back. Make in India worked. That's the narrative that will be sold. What's likely going public is a Chinese majority orders company wrapped in an Indian name built on a subsidy regime the government is already redesigning, approved under a rule that the government has already rewritten. In the next 2 quarters, the DRHP, also known as the IPO disclosure document, that a company files when it wants to go public, will answer one question. How much of this 10 times revenue is Huachi and how much of it is Bhagwati? If it is mostly Huachi, which it probably could be, this IPO isn't what the banker prospectus says it is. It is a test case. And every future Chinese joint venture in Indian manufacturing will be priced against it.